So this week we talked about financial statements and how important they are because they give us a look at the financial condition of your business. Financial statements can be done at any time, but they are normally done at least annually. Any publicly held corporation is required to do them annually, and most privately held corporations do the same. There are four major financial statements. There are other ones too, but the four major ones are the income statement, also called the profit and loss, and that reports profitability for the period the statement covers, so usually a year, or it could be less. And the point of this is to show whether the company has been profitable for the last year or so, okay, or whatever period you're doing. So on the income statement, what we report is revenues and expenses. Okay, so revenues and expenses go on the income statement. Okay, if revenues are greater than expenses, you have net income for the period, or net profit, and that's often referred to as being in the black. That's where they get the term Black Friday from, for the day after Thanksgiving. If revenues are less than expenses, you have net loss, and that's referred to as being in the red, because they used to use red ink for that. Now, the second statement you would do is called the Statement of Owner's Equity, or in a corporation, it would be called the Statement of Retained Earnings. Okay, so the Statement of Owner's Equity reports the change in the owner's equity over the same period as the income statement. So the owner's equity is going to change based on whether you have net income or net loss. Okay, and we'll talk about owner's equity in a minute. Okay. And then there's the balance sheet. Okay. So while the statement of owner's equity and the income statement cover a period of time, the balance sheet is a snapshot. Okay? In other words, it's only on a specific day. And it lists the company's assets, liabilities, and owner's equity. Now, normally it's done with the other statements, but it's not measuring activity over a period of time. It's what the balances are on a specific day. Normally, again, the end of the year. But it could be any time. Okay? The statement of cash flows is the fourth one, and that reports the sources and uses of cash. It's a complicated statement, and most small business owners don't even have to worry about this statement. But if for some reason you ever need to, it's something you can look into. It's kind of beyond the scope of this course. Now, we've looked at some different terms when we talked about the financial statements, but what do they mean? Okay, well, an asset, right? An asset is an economic resource that will provide a future benefit. What's that benefit? Revenue. Right, so like a truck, land, machinery, a building. You know, if you were a landscaper and you had your weed whacker, that would be an asset, right? You're going to be able to use that to earn revenue in the future. Okay, liabilities, that's a creditor claim on your assets. So, if, for example, you buy a truck for your business and you finance it, some of that, okay, is going to be owned by the bank. Okay, in other words, you have this asset, truck, that you're using to earn revenue, but the bank owns part of it. They have a claim. Okay, your claim on the assets, the owner's claim on the assets, is known as owner's equity. Okay? Now, depending on the type of company you have, okay, it could be the owner's capital account. So if it's a sole proprietor or LLC, it's going to be called the owner's capital. If it's a corporation, it's going to be common stock. Okay, all right. So, and there's another account called retained earnings. Now, most small businesses start out as a sole proprietor or as an LLC. So we're going to kind of take it from that viewpoint. Okay, so we're going to look at it in this sense, like sole proprietor or LLC. Okay. All right. So what does owner's equity consist of? Well, we already kind of talked about the owner's capital account. We also measure revenues. Okay. And it would be impractical to record every transaction that affects owner's equity in an owner's capital account. So we create these sub-accounts that we use to temporarily measure activity, like revenues. That's the earnings of the company. Expenses, that's the cost of earning revenue. And there's no future benefit. So that's what differentiates an asset from an expense, right? The asset, like the weed whacker, that provides a future benefit. I can use that for a number of years to earn revenue. My utility bill, once I pay it, I have no future benefit from an accounting standpoint. I'm paying for utilities I've already used. When I pay my employees, I'm paying them for work they've already done. So there's no future benefit. So that's an expense. And an expense has to be part of the cost of earning revenue. So when a sole proprietor wants to take money out of the business for his or her own use, that's not an expense. That is not part of earning revenue. That's called a withdrawal. So remember that the law sees a sole proprietor or even an LLC and its owner as the same entity. So if you're a sole proprietor or even an LLC, you can't take a salary in the traditional sense. You have to take a withdrawal. Okay? And then if it's a corporation, you would get dividends. Be part of the net income that's shared with the stockholders. Okay? So these are the three you really need to kind of focus on right here. Right? Okay. All right. Okay. So in order to do financial statements, it's important to understand these terms. So we did the yellow pad company. We were able to complete the income statement and the statement of owner's equity in class. And so in the next video, we'll go over that. So thank you for your attention.